So this is Market Mondays 101. So we're going to get started with what the stock market has, what it has to bring. And we have two panelists with us tonight. We have Jay Bolton, hometown Longview, Texas, education. He has a bachelor's in science and psychology at the University of Texas at Arlington. His occupation is Fidelity Investments 401k specialist, and he's a founder of Decoded Value Investments, and he has his own blog as well. So we thank you, Jay.
Thank you.
Brandon? Can you speak
Next,
on
we have Michael E.J. Michael E.J. is from Houston, Texas. He graduated with a bachelor's in finance from Texas Tech. Go Red Raiders. He is an institutional investor at the Teacher Retirement System of Texas. He has worked for Goldman Sachs, Raymond James, and he's also a long-term investor who likes to write as well as create videos. So you can catch him on YouTube, and you can also check him out on Medium and Seeking Alpha for further investment research. So Michael E.J., we thank you as well.
Wow, thank you. Thank you very much. I guess I will get started in driving the agenda here and what we're going to talk about during this presentation. We got a number of things, having the right mindset, key concepts to understand, how the stock market works, and actually how to get started. So we're going to cover each step. Next slide. So why should anybody invest in the first place? Why should you even think about it? Let's see, next slide. So there's a number of reasons. It helps you in building an account, helps you from stop living paycheck to paycheck, getting out of that rat race. Helps you build up some funds to do some other things. Let's say you hit a certain milestone in your investment account, you can use some of your funds to go on vacation or even save up to buy a home. Maybe you want to have your money start working for you. I mean, we all hear about it. You know, you want to get to a point where you have your money start working for you. You can start at a very small amount. Create a passive income stream. If you into that, you can do it through the stock market, primarily through dividend investing, and just become more educated about financial markets. It's one thing to try to learn about them on your own before investing, but your attention span is going to be totally different once you actually put some money to work, and you're going to really start paying attention to what's going on. Okay, so what's holding you all back so far? So what's holding us back so far? So before I even start on this, Jay, since you're also in the field, like in the beginning, what held you back from actually getting started in the stock market?
And just going back to the previous slide, just lack of exposure. We haven't been exposed to something as a young child. It's not talked around the dinner table.
Your parents can't tell you something. You just have to search on Google and find everything from the ground up. So you're searching and you're grinding for that knowledge, and you have to find it yourself. So just the initial knowledge for me was the hard part, and then just learning what a stock was, why I needed it, how that could actually make money and benefit me. And once I found that, it just changed my mind. It's like the matrix just opened. So,
oh, that's what's up. No, that's definitely what's up. And that was it was similar for me. Part of it was a money issue. I started gaining the knowledge and didn't have the funds. And then another part was, especially thinking about longer term investing. Sometimes I think one thing the stock does something completely different. It freaked me out, but not realizing like, hey, this is part of the process, right? This is a long-term game, right? So that's one thing. But similar. It's like an education process. Slide. So yeah, what's holding us back so far? If you are investing in other areas, if you have a business idea, keep pushing with it. If you're more in the real estate, that tends to be a thing. If you're in the real estate investing, that's fine. Even if you like reinvesting in your career, it's perfectly fine. I mean, you should still get involved in the stock market, but it's not the end of the world. If you got other endeavors, that's a good thing. The second problem was a problem I initially had, which is not having enough money to invest. And if you don't, that's a totally different problem. We're going to have a totally different conversation about that, right? But the two big things we're going to touch on during this presentation is not knowing enough and the fear of losing money. So just as Jay mentioned, and same thing for me, not knowing enough, not knowing how the game works, right? Not knowing that it's okay to occasionally lose money from time to time in the short term, or not knowing that the key to really building wealth is to add as much money to your account as possible and then get to a point where your money can really start working for you, right? So things of that nature. Next slide. So what do you need to get started? First off, be nice to have a little bit of a steady income. If you don't, maybe you're in a commissions-based type of role right now. Cool, that's fine. It's a little bit different for you, but for the most part, if you have a steady job, that's fine. If you got some extra income after paying all your bills and expenses, that's cool. This is where it starts to get a little bit controversial. I would like to get Jay's opinion on this. For me, if you just have an emergency fund, maybe $1,000 or so saved up, that you're good to go to actually start investing. But some people recommend having 1 month, 3 months, 6 months of expenses saved up before you really take that seriously. So Jay, for you, what do you recommend on that before actually getting started?
So for me, I think that obviously you should have, that money saved up. I got started investing a lot younger. So I was a freshman in college. So I didn't have, an emergency fund and really even like had that pillar of financial, the financial totem pole laid out. So I had just, fractional investing had just come out, like Stash and M1 Finance and things like that. So I could actually just put like $100 in, $10 in. So I think that you have to just get in the game so you're not scared. I do think you need that emergency fund and that money stacked away for anything, if anything happens. But everybody can invest $10. I'm more of everybody. You just have to do something. You just have to invest in your favorite company and just start small and build from there. And then once you see it work, your life will forever be changed. You'll always want to put more money in because you see your money's making money. So there's no fear anymore. If you give it time, and if you just put $10 on Stash, I remember my $10 went into $20 in a couple months one time, and then $20 goes into 50, and 50 goes into 100, and then you're like, dang, if I would have been doing this, I'd be rich. It's not even hard to understand how people get rich. It's just you just kind of see everything unfold, and that's how I started.
No, that's a very good point. It's kind of magical seeing it once your account starts really building up. Even if you're starting really small, once you start seeing your money work for you, you all of a sudden want to sacrifice everything to put more money into your account, right? So that's a good point. And also, last thing you need before ever getting started is just a plan, right? And this is why you're here. You're here. We're going to help you at least with an initial plan and understanding how the market works. So next slide. So some key concepts to keep in mind. First off, what a stock is in general, right? A share of stock, one share, right? That is equity ownership in a company, right? The key to wealth building is ownership, right? And it's not just owning real estate or owning a business, a private business. It's okay to own a public business as well. Don't get me wrong, you're a very small owner. So like most companies have millions of shares, right? And if you just own one share, I mean, you're less than 0.1% owner of that company, but you still matter. If there's a vote for anything that's going on, you need to put in your input. They're going to ask you for your input. And you got to put in your input. So that matters. Next is the ticker. right? So that's just shorthand for a company name. So for example, SBUX is shorthand for Starbucks. Got dividends, that's a distribution of profits. Some companies pay to shareholders, not all, but some companies pay. You have a brokerage account, that's the account you're going to use to buy and sell shares of stock. And you usually work through an investment broker. That's a firm that buys and sells stocks on your behalf, right? So how it usually works is you put in a buy or sell order. It works through the broker, and the broker actually communicates that to a market exchange, right? A market exchange is a centralized location where investment brokers go to buy and sell stocks on behalf of their clients. So New York Stock Exchange, for example, in New York. There's another one that's for more derivative markets in Chicago. We're not going to touch on that. That's a different day. But yeah, that's centralized location. And last thing I want to touch on is very important, is exchange traded funds. It's a stock that holds other stocks based off of a characteristic or theme. So just think about getting Gatorade. You can buy Gatorade at a gas station right now, any flavor you want, right? Or you can go to like Costco and buy one of those large packs of Gatorade. And some of them you like a lot, others you can go without, but the common theme is that they're all Gatorade, right? So exchange traded funds the same way. Instead of you needing to buy a whole bunch of stocks for diversification, you just buy one exchange traded fund, you're good to go. Okay, next slide. So why do stock prices change on a daily basis? And this is very important to keep in mind, because once you understand why stock prices change on a daily basis, you'll have a better understanding to be okay if occasionally you lose money from time to time. Because over the long term, you are better off investing in the stock market. Next slide. So what drives the stock market is pretty much the expected demand of stocks. Going back to basic economics 101, I don't know if anybody remembers that from college or high school, but this is all supply and demand. And for the most part, supply is really fixed. So is the demand every day that drives the stock market. Market exchanges, they want an equal amount of buyers and sellers for stock. Because they're just market makers. They just try to create the market for you can be on one side or the other, right? It's very similar to what Uber does. Uber is a market maker, but for ride-hailing services, right? Similar to a taxi. Or when a casino sets a sports betting line, they're trying to set a line that there's equal amount of people is going to go over and under that sports betting line. So similar thing, trying to set the market. Next slide. So even though it's supply and demand, it's more so on expected demand, what we expect to happen, right? Who is anticipated to be the next market participant in a stock? Is it a buyer or is it a seller? Because market exchanges want an equal match, if it's a buyer, if they expect a buyer to be next, they need to find a seller. And if a seller, they need to find a buyer. You entice sellers by increasing the stock price, or vice versa. You entice trying to find buyers by decreasing the stock price. Anticipation is driven by daily news. So, I mean, you see it all the time. It happens all the time. Especially if you're focused more on trading and if you're trading more off of the news cycle, right? So you see some good news happen, more expected demand happens, it increases the stock price, right? Bad news happens, you expect less demand, it decreases the stock price, right? It's all about trying to find, just think about it like trying to find the fair value of a company for a business or a startup. But for startups, if you work at a startup or whatever, they raise money like once a year, right? So they trying to find the value of their business once a year. For a public company, it's just a continuous cycle, right? It's just a continuous move. Just always trying to find the value of a business. And big moves in the stock market usually comes from unexpected news. So, for example, take this coronavirus, where the stock market fell mid-February to mid-March, maybe about 30, 40%. Nobody saw the coronavirus playing such a big role in the market and changing everything. So that's what led to the large price decline. On touching on this point, Jay, I know you're more in the trading than I am. Do you trade a little bit based off of news or on supply and demand indicators?
So I definitely use some supply and demand. Another way I would characterize supply and demand, maybe if it resonates with your brain easier to the people, fear and greed. So fear is going to be that supply, because this negative news, coronavirus, everybody's going to die. You don't know, you better get your money out of your 401k. We have to cash out. It's the top, and that's causing a massive amount of supply. Everybody wants to sell at the same time. They're trying to get, you have to imagine, if you had $1 million and then your house was worth 900,000 and you're just trying to sell as fast as possible to lock in as much profit as you can. So it causes a mass panic all at one time. And that's why the stock market drops. And then when there's good news coming out, Trump says we have a deal with China in the trade war and everything. The economy is the greatest thing in the world. And you feel like you're going to miss out. And everyone's talking about Tesla and, Tesla is the greatest stock in the world. And people who don't even trade stocks know anything about the stock market are talking to you about Beyond Meat because we have a meat shortage going on, so it's causing that greed, and everybody wants a piece, and then the stock market keeps going up and up and up, and the stock it won't stop. So that's how I like to characterize supply and demand as well. And it's just human nature. So what you're really when you're trading a stock, even when you're investing in stock, you're dealing with human nature, and that's why stocks go up and down, either our fear or our greed. And we just have to capitalize on that. And the way you do that is you pick your favorite companies and you just pick your spots in your favorite companies. And a lot of times when you get more experience, you're excited when companies drop, because you don't get to actually buy Amazon a lot of times at a discount, or buy Visa a lot of times at a discount, or buy Nike a lot of times at a discount. So it's a good thing. Some want your account to go down in a way so you can buy more, because you know you're not going to lose over the long term.
Oh, that's a good point. And yeah, that's a good way of thinking about it. Fear and greed. Fear and greed is a real thing. No, that's a good point. No, that's definitely a good point. Think about it in fear and greed terms. And again, you're right. Over the long term, sticking with any strategy is going to work out. Always going to work out in the stock market. Next slide. So we kind of just touched on this, but while these large price declines don't matter in the long run, if you're looking in the long run, at least 5 to 10 years of being dedicated in the stock market, no matter if you want to go take more of a trading route or investing route, over a 5-10 year span, you will make money in the stock market. Like it's always more good news than bad. It's always going to get better. The stock market, and it's the same thing with business ownership in general, or any entrepreneur, just naturally more optimistic. The stock market's no different. If you go back to the 1920s, for every one bad year in the market, there's 2 good years. And really, the 20s was a completely different time. I mean, you got the Great Depression going on. You got some wonky things that were going on at that time. So the market looks a lot more like how it looks today. It looks a lot more like how it looks started in the 1980s. For every 1 bad year, you got 3 good years, right? So 1 bad year to 3 good years are going to make up for it and then some. The key is to stay consistent and don't pull out, no pun intended. All right, next slide. All right, so I'm hoping Jay and I have you all feeling a little bit more comfortable about the stock market now. Before telling people how to get started, Jay, you have any other comments on maybe help people get even more comfortable about the stock market and how it works?
Just want to reiterate. Sometimes you just have to jump, and you realize it's like the stock market is like swimming, or when you're afraid to jump in the pool because it's cold, and then you realize it's not that bad, and then you see it's actually a little bit refreshing. Do it. It's not one of those I can't teach you the feelings you're gonna feel. I can't teach you how you will react. You really just have to get in there, and you can do that for as little as $1 now. with apps like Cash App and Stash and M1 Finance and even Fidelity. It's allowing people to do fractional shares now. So it's like there's no excuse for people not to refrain from investing anymore. If you can buy a burger from McDonald's, you can own McDonald's stock. And why would you not want to own McDonald's? Why would you not want to own Google? Why would you not want to own Netflix? Why would you not want to own Amazon? You shop on Amazon and you search on Google every day and you go on Netflix. Why would you not want to own a piece of the company that you use every day, all the time? You know, I like to eat Chipotle. I love the stock. It's like my favorite food stock right now. And you feel good when you buy a company or something that you actually use. So that's my whole philosophy. Buy Microsoft, buy Nike, buy Google, buy Amazon, buy stuff you use, and everything will take care of itself. It's not complicated. You will make money over time. I know they say there's no guaranteed returns, but over 10 years there are. Over 5 years there are. I can't tell you what happened by the end of this year or 2 years from now, but 5 years from now, the market will be higher than it was today.
Exactly. I feel the same way. And it's true. It's definitely true. It shows out in the numbers. So hopefully people are feeling a little bit more comfortable getting started in the market. I don't know if we should maybe we'll save questions till at the end, but for those who are comfortable and want to actually get started, we have a little bit of a plan to help you get started. Next slide.
So I just dealt with the fear by knowing what you own. You know what I'm saying? Like, again, you shouldn't be afraid to own Amazon. You use it. Like, if you use it, you know it's a good product. It's not like you're buying something and you don't know what's going to happen. Your parents can't tell you anything about buying Amazon. Your family can't tell you anything about buying Nike. If you have 10 pairs of Nike shoes, why wouldn't you own one share of the stock or $10 of the stock? If you eat McDonald's 3 times a week, you can own $10 of the stock. It's not a risk. The stock market is the only place where you can put your money and it doesn't disappear. Even if you're down on an investment, it's called an unrealized loss because you haven't actually lost any money until you sell it. So I could put in $100 in McDonald's and it goes down to $80 tomorrow. And unless I sell it, I haven't lost any money. It's just paper. It's an abstract idea. And if I log back in 3 months from now, I could be at $110, and then I have an unrealized gain of $10, and I have to sell that position to actually have $10 worth of profit. So that's the only place where your money just doesn't disappear besides real estate and businesses. So if I go eat at McDonald's, my money will be gone forever. Like, it's never coming back to me. But if I invest in the company, I always have a chance to gain more of my money or at least preserve it.
Oh, that's a fact, and the unrealized losses thing is huge because that's what leads to the fear and people being afraid when the market's crashing. It's like, it's not real. Like, everybody calm down. It's not real. It's not you haven't experienced it yet until you actually sold out of the stock, right? So and it's just, again, having that long-term mindset, staying with it for at least 5-10 years, if not much longer, and you will come out on the other side much wealthier than you are today. So how to actually get started in the stock market? It's a quick 3-step process, right? First off, you can open an account with an online broker. Offers free trading, so they don't charge you for buying and selling stocks, as well as, like Jay mentioned, offers fractional shares, right? So Jay works at Fidelity. That's a great place to start. Stash, you mentioned Stash. I think Stash you can start as little as $5. Is that correct? Start with $5.
I think Stash does 5.
Yeah, you can start with $5. M1 Finance. That's the one I started off with M1 Finance. And their bar is like $100, but that's before I learned about Stash. But yeah, so
and even also Cash App, the app it allows you to invest for $1 now. Like, you just need $1. So there's literally no excuse for you not to. Everybody who's on the call tonight, at the very least, go log into your Cash App. I know everyone has a Cash App in the times we're in. Buy at least buy $5, $1 or something, just to say you're officially an investor, no matter it be fractional shares or not. You're officially an investor, and you can start seeing how the market moves, and you got the first step out of the way, and everything is up from there. So
Exactly. No, exactly. Just start off small. That's fine. And that's real small. Like you have there's no excuses, no excuses anymore. So in this presentation, I mentioned starting off with at least $100, but like we mentioned before, you can start off with much less. Start off with whatever you have. And I would say, especially for those who are getting started and just want to dip their toe in, and they're trying to put in a little bit more. Let's say that you're trying to put in $10 into the market. Don't put in 10, maybe set $1 or $2 and just keep it in cash. Right. So and that's more so a defensive type of thing. So you get a feel for things. You can become more aggressive, invest all your money once you get more comfortable. But it's something about the mindset. At least I have some money in cash that kind of helps with the mindset and help keeps you going and progressing in investing. And I'm going to talk about ETFs here, but Jay also has like some individual stocks you can focus on as well. So I'm going to touch on these ETFs right quick. And they're based off of how you like your personal risk tolerance and how you feel about investing. You can go the offensive route, be great at offense, or go the defensive route, be great at defense. So next slide. So offensive slot ETFs. I believe that there are big themes that's happening in the world, and they also work very well for picking stocks. And I listed 3 themes that's just going on in the world, even in the midst of all this coronavirus and all this stuff. These are big themes that I think we all understand and can get behind. And even if you don't want to do fractional shares, you want to buy full-blown shares. These shares are relatively affordable. So I have a video games and sports ETF. The ticker is HERO. For those who occasionally hop on video games, I don't know how many people actually are still into it now, but we know the younger generation definitely is. So you can just invest in all the companies that are behind them. So EA for Madden, you got Nintendo, Activision, Blizzard for Call of Duty. If you're in the 2K, you got Take-Two Interactive. You got those type of stocks, right? A lot of other stocks that are in China where esports and video games are picking up as well. We also have a millennials-based ETF, which is just consumer companies that will benefit from the rise of us millennials spending more money. Well-known names like Apple, Amazon, Facebook, PayPal. And also for those, who are Tesla fans, but once you start actually looking at Tesla, see how volatile the stock is, you might be afraid to buy a Tesla stock, but it's okay. If you still believe in the company, you can, or just believe in the space of electric vehicles or autonomous vehicles, that's an ETF for that too. There's other companies getting in the space, including Microsoft, Google, Samsung, Apple, Toyota. So if you want to kind of hit for the, swing for the fences and really get behind, things that you expect to last for forever, not forever, but long-term growth themes, this is a great place to start. And then we have some defensive ETFs as well. Next slide. And these are more so for people who are super conservative, really scared to hop in, but you need to hop in, right? You need to hop in, and you're not going to lose that much money with these ETFs, right? So there's one that's called the minimum volatility ETF, which is just essentially large companies that have low business uncertainty. Like what you're getting with these businesses, right? Like Jay mentioned McDonald's. You know what you're going to get with McDonald's from a business performance perspective. Coca-Cola, Waste Management, the ones who pick up your trash, right? Verizon, right? You know what you're going to get. You also have the dividend aristocrats. So for those who are interested in passive income through the stock market, you're interested in dividend investing. These are companies that consistently paid dividends to shareholders over a long period of time. I'm talking like 20 plus years. So Pepsi, Walmart, Target, Lowe's, also a lot of companies, what you're getting business wise. And if you're really scared, go with the utilities ETF. companies that operate in the utility sector, the safest business in the stock market, hands down. So that's some ideas ETF wise. Jay, for like individual stocks, where would you suggest some people get started?
Before I go to the individual stocks, just like to say, I started off investing in like index funds too, like the S&P 500. That's definitely like when people refer to the market, that's what they're talking about. So if you hear someone talk about the market did this, that, the market did that, they mean the S&P 500 fund, and that's basically all of America in stocks in one fund. So it has Amazon, it has McDonald's, it has Waste Management, like he said, the trash, it has Google, it has PayPal, it has Apple, it has Nike, it has every single stock there is in the stock market basically in that fund. So you're just betting that over time the stock market in general is going to go up, and it's a lot less risky per se than owning Amazon by itself. You don't have to bet on Amazon alone. You just have to bet that the stock market will go up in the future. So that's why people do that. And also what EJ was saying with say you have $10 invested and you're saving two, that's to go more in depth on that. You're doing that. So let's say you bought Amazon, you bought $8 of Amazon after this call, and Amazon dropped by $50. You could feel better about your investment decision because you didn't put all your funds up at once. So you could actually like rejoice and be happy that you got Amazon at a cheaper price and you got to average down on your position. Or maybe that extra $2 just put you up because like the average between the two stock prices, you're just up after you bought the difference in price, and then you're up and you got to feel that win. Like I like doing that with trading and investing. Like if I have a goal to buy 10 shares, I might buy 2 on a Monday, 4 on a Wednesday, 3 the next week, just depending on the stock that I'm investing in, how the market's going. On the individual stock side, I would say to get started, invest in what you love so you can really feel good about your decision. Like invest in what you like. I was always, when I saw Visa stock, I don't know what it is, but Visa is like basically like my favorite stock still to this day. It's not even the most flashy stock. It's just, I always saw Visa on the card, like, and I was like, Visa's on every single card, every credit card, every debit card I've had. It says Visa or MasterCard. I don't know. I just like Visa better. I always like Visa better than MasterCard. Like there's nothing wrong with MasterCard either. I just liked it. So I think if you're really a shoe person and you buy Nikes all the time, buy Nike as your first stock so you don't feel bad if it goes down $10 when you buy it, because all right, Nike ain't going out of business because you keep them in business yourself. You at the Nike store more than anybody else. You know about all the trends. It'll make it easier for you to invest. It'll make it easier for you to understand. And part of investing is like research a little bit, like knowing about the company, what they do, where the technology might be going in the future, where you see the future of the world going. And if you see Nike in it, and clearly you do because you always shop there, and you know everything about the next greatest shoe, that's something you should invest in. Also, just Amazon, Netflix. If you watch Amazon, Netflix, if you use Amazon, if you use Google, invest in them. NVIDIA, I like NVIDIA. They're basically the chip maker in all the phones, in the Tesla car, in refrigerators. The new smart homes. There's just all types of. I have a whole list. I think that's something we'll eventually on another Market Monday go further in depth on sectors of the economy and what you might want to have and where trends are going in the future. But I would say just buy what you love. If you have an iPhone, you rock with Apple. You always calling everybody trash because they got their Android, or you own some Apple stock. And it's not more complicated than that. You'll be fine over 5 years, like we said. Even probably a year with Apple, you'll be fine. It'll probably be higher next year than it is right now. So I think that's the easiest way to begin. And it's not really more. It's not you can overcomplicate it, but it's not. And you don't have to. The thing about the fractional shares is you don't have to worry about what's cheap and expensive anymore, because even though Amazon costs a lot per dollar amount, Apple might cost $300 a share. you can invest $5 in it, and it still moves the same. 5% of $5 is still 5% the same way the 5% is going to be on the $310. One's just going to be you add more money. So I make 10% on $20, I got $2. I make 20% on $200, I made more than that. So it's just you have that. You just have more. The more capital you have, the more money you make. But making money is making money.
No, that's a good point. That's a great point, especially starting with stocks you love. That's how I got started. I got started with Nike, right? I got started with Nike. I was back in my college days. I was a lot more into the Jordan game, and that's literally how I got started. First stock I bought was Nike, right? And I kind of loaded up on it, and then I learned a little bit more about diversification, learned more about reviewing financial statements, and believe it or not, that led me to Target, right? So Target was the next stock I bought. And then I went on a pattern from there, right? And I also agree with Jay, man. Nvidia is my stock, man. Nvidia is the company of the future. Everybody hop on while you can. So you take nothing else from this call, buy Nvidia. That's all I'm gonna say. All right. So yeah, that's all we have. Next slide. Now you all have the keys. Everybody got the keys to get started. I don't know if we can open up for questions now, but I think this would be a good time to ask either myself
One
or
more
James
thing before
go ahead.
before we do questions. Just like people will try to tell you you're wrong about things, or there's really no perfect way to. We can make the stock market really complicated, and it can be really complicated. We can tell you all these things, but you get so scared that you never invest. You literally, if you love Nike, I don't care. Nike could be your only stock forever, and you would still be better off than the rest of the population who doesn't invest. And actually, you've probably outperformed the market as a whole just holding Nike rather than owning all these different ETFs and having to deal with the more nuanced things of the market. If you don't have to turn on the TV, you can just say, hey, I like Visa, and I'm gonna buy Visa, and I'm gonna sit it and forget it. And if that was your only stock in your portfolio, you'd be fine. All you have to do is when Visa is down, buy it, and it'll go up more than it's down. But the thing about the stock market is it's rigged to go up. 70% of the time, the stock market's going to go up. 30% of the time, it's going to be down. And during that 30%, once you realize that it works, you should really be happy. It's just about controlling your human emotions. But once you invest, it makes you money. What it does, so you kind of less fearful, and you kind of look at it as more of an opportunity. The more you grow, and the more you get in the game. If Amazon drops a lot in price, it's a gift. It's just like it's like a Christmas gift. It's like the best gift you could get if Nike just something caused them to drop for a little bit of time, or something caused Visa to, like, coronavirus is really a gift if you had your money up. And the good thing is, like, even if you don't have a lot of money, like fractional shares work too. So $200 could have went a long way, and still can go a long way right now. $100, like that's how I started, and then I built a portfolio. I would say don't focus on the dollar amount of your gains right now. Look at the percentage. Even with trading, that's what I try to do. Look at your percentage, not the dollar amount. So am I up? If I up 30% a day, or I'm up 10% for the week, that's what I'm shooting for. I'm not shooting for, oh, I got to make $1,000 every day. I got to make that's all good. But if you focus on a percentage, everything else will come. The money coincides with the percentage gain.
Oh, that's really good advice. Definitely got to get started, and you'll learn in time to focus on the percentage, because you're going to start off small, but you'll see the more money you have, the more it's going to work for you.
Hey, I have a question for either Jay or EJ. What do y'all think about the spread between value and growth? Do y'all see value coming back into play? Or do y'all think that, this is a new growthy environment, and this is the environment we'll be in for the next 5 to 10 years? Let me know your thoughts on that.
So I'll take it first. I think Brandon is slick in asking this question, because I think he already knows my answer to this. It's one of the things I write about on my Medium blog. How I think value investing is dead and how growth investing is going to like take over the world. So overall, I think growth investing is going to continue to lead value. And it's primarily because of how the market has changed over time. Value investing worked very well when there was a lot of individual investors like you and I in the market, right? So we used to dominate the market in the 20s, 30s, 40s, 50s, and 60s, right? It was primarily.
Hey, EJ.
Yeah.
And before you go on, can we just explain what value is and what growth is for people unfamiliar? Like,
Yeah,
can you give
thank
an
you,
example of what a value stock is and what a growth stock is? So it's talking about it's not complex, guys. It's just a jargon. And as you invest more, you'll get more familiar with these terms. But it will make sense once we give a little example.
Of course, I
I
already
didn't want to
jumped.
cut you off. I was just
No, you're good. I jumped way too ahead. You're a good point. So value stocks, the best way to think about them is every stock has like a price, right? We think about it in terms of valuation multiples, right? That's the price of the stock relative to how much money they make, primarily through their net income, right? So we're going to probably have a series where we talk more in depth about what to look for on the financial statements, what to look for whenever you're trying to understand a company. At the end of the day, it's all about how much that company makes and profit. And what you'll see is a valuation multiple, which is how much is a company worth per dollar of net income they have. It's the best way to think about it, right? Over the long term average of, I guess it's called price to earnings multiple. That's the most common multiple. It's what's the price of a stock per $1 of net income that's generated. Over the long term, the price to earnings multiple is about 16 times, right? So whenever you see a price to earnings multiple, think about 16 to 18. That's the range for the market average. When a stock has a price to earnings multiple below that, we think about it as a value stock, right? And usually it's connected more to their growth. The valuation of a company is dependent upon the growth prospects of a company as well as the risk connected to that company. But people don't really think about the risk, they think about the growth. So if you see a price to earnings multiple for a company below 16 times, you can generally think about it as a value stock. And not just above 16 times, but maybe closer to 25, 30 times and above. You can think about those stocks as growth stocks. So that's like a general difference between value and growth. In a nutshell, there's a lot more to it, but that's the general difference between the two. If once you start digging deeper into the stock market, you start to realize that the changes in that valuation multiple can drive stock returns, but also a company that actually grows earnings can drive stock returns over the long term, right? So your Warren Buffetts of the world that got started in the 50s, 60s, 70s, they did well through value investing because value investing implied that some stocks had a low valuation multiple, even though they shouldn't have had a low valuation multiple. And that's because valuation multiples moved around a lot more when it was me and you buying and selling stocks. Over time, the market has turned more into institutional investors like Teachers Retirement System, where both myself and Brandon work, right? So as more longer, and we're considered to be more longer term investors that don't move as much on emotion, right? So as longer term investors got into the market, the changes in that valuation multiple, or the changes in stock market sentiment, they're not as prevalent as they used to be in the past. And there's a lot better, higher quality companies in the world today. I mean, if you think about Facebook, Amazon, Apple, Netflix, Google. They're called the FANG stocks. These are the 5 stocks that are essentially dominating the market, and they've continued to beat the market. You can do well just invest in those 5 stocks and forget the rest of the market. And they're going to continue to do well and dominate because they're just higher quality companies for a number of reasons, right? And there's a lot of companies like those, whether that be NVIDIA, whether that be Salesforce. Visa is another one. Visa is a great company, right? Visa is an awesome company that's growing at a high clip, even at its size, growing at a high clip, right? So there's a lot of companies that are out there that wasn't in the past. So that's why it's, in my opinion, growth stocks are the way to go if you're going to invest in the stock market, and to ignore the value stocks.
Just to give my take on it, I like to use analogies to help me with the stock market. I'm not very smart, so I like to use things like basketball and things like that. So y'all bear with me. So a value stock, think of a value stock as like Tim Duncan. He gonna get you 25 a game, 20 a game, and you know you can rely on him, but he's not gonna win the game by himself. He's not gonna be Kobe Bryant and drop 40. In a growth stock, it's Kobe Bryant. A growth stock is LeBron. And even if a value stock, I know they're valuable, I want that 40 a game because that's what wins championships. You know, Tim Duncan, he might get us to the playoffs, but he's not gonna finish the deal. And I want 40 points, not just for maybe, you know, the value stock. They might, you know, Tim Duncan his team might be successful, but LeBron sells tickets and LeBron generates revenue. LeBron is the face of the league. It's the next hottest thing. He's that person. And I would say, to give an example of a stock versus a stock, like a value stock is, I would consider that like Coca-Cola or Procter and Gamble. Coca-Cola, everybody knows what Coke is. Everybody drinks Coke's products, Sprite, Fanta, just the regular Coke. When you say a soda, you say, "Can I get a Coke?" But they're not growing anymore. They're just gonna be stable. Like they're fine for, like, you know, giving you like dividend income, but they're not. When you compare Coke to Visa, or you compare Coke to Shopify or Amazon, why would I try to like why would I, if you're choosing basketball players, why would I pick Draymond Green when I could have LeBron? Like, who's gonna win the game? Who's gonna score more points? Who are you gonna enjoy seeing play more? And that's how you have to think about the investing. Even if they say something is, oh, Amazon costs so much, Amazon deserves its valuation because they're taking everything into, it's the whole world. Amazon is basically controlling the whole world. They're becoming like a mini Netflix. They're killing the retail store spaces. They're killing all the malls, and they are the hub. Why would I want to own Coke when I can own who sells Coke? Coke has to give Amazon a cut of their profits because they need to sell on Amazon's virtual shelf. So that's why Amazon is worth more. That's why Amazon is Kobe Bryant, and Amazon is Kobe Bryant. It's the all-star team. Amazon is the all-star, and then Coke is like Stephon Marbury. You know, it's like, it's cool. He was a good player, but he not. Nobody's saying he's a 15-time all-star like Kobe Bryant, and you're gonna give, you know, that person the ball when it's time to hoop. So that's what growth versus value is. And I think that value investing is not dead. I just think that Amazon is value. Nike is value. You know, like some of these tech companies, because we lean so much on tech and it's a new world, Facebook is a value stock. It's just a value stock that grows because Facebook is essential. You cannot live without Facebook. You can't not go on Instagram anymore. You can't not go on Facebook or people use WhatsApp internationally. You can't not you will buy something from Amazon within the next 3 months. You can't not go surf the web every day. You can't refrain from using Google um, or doing a search. You can't stop using Zoom. We're using Zoom right now. Zoom is valuable.
Man, why you have
A
to do
lot of
stuff
times.
on Margaret like that, man?
I
I like when
couldn't
I
think
think
of, I couldn't think nobody. I couldn't think of nobody else in my head.
That was the
I have a
perfect
question.
scenario.
I have a question. Hello.
Go ahead, James.
Do you guys feel like we should read the financial statements when trying to figure out what stock to choose from? Or how do you guys go about actually picking a stock to invest in?
Let me go
Also,
for EJ because I have a feeling of what he gonna say.
one
For
second.
me,
One second.
go
I
ahead.
don't mean to cut you off. We
Go
have
ahead.
about 5 minutes and 30 seconds before the meeting will end again. So just kind of FYI.
So for me, I didn't start that way. I know it's important, but you don't have to read Visa's financial statement. You don't need to read Amazon's financial statement. Like there's nothing on there that's you when you know the company is good, you don't need to do it. I need to read Procter and Gamble's financial statement to see what they're gonna grow over the next 5 years to see if it's worthy of my time. I don't need to read Facebook's annual report and balance sheet. I know they're going to give me 20% on my investment in 5 years, at least. That's just my opinion. Like I know everybody does it, but I actually, when people say things are overvalued and, get where people are being greedy, and then just don't be a hog and get slaughtered. Like, it's like, if I told you it was going to make $1 million and all you had to do was sell it $1 million and not try to go for 10, that's kind of what you have to do with things like Facebook and Google and Amazon. You just have to not be too greedy, but know that that's where you need to be. You kind of just have to have a little bit of discipline and sell sometimes when it's getting at too much of an extreme.
Okay, I'm gonna make my answer pretty quick. I actually, for the most part, especially in the beginning, definitely agree with Jay. If these are big, well-known companies that we know is going to be around. We know they're going to grow. They're going to continue to dominate. If you're going more down that route, that's the route we suggest you going down in the beginning. Definitely, you don't have to worry about financial statements right now. Don't worry about that right now. Just get in on high-quality companies that you know are going to grow or that's going to pay a dividend or whatever you're looking for. Get in on those stocks now, right? And then over time, if you want to mess around, try to learn more about financial statements and what to look for, then you can go down that route. And again, I'm pretty sure we're going to touch on it at a further Market Monday updates, right? So if anything, that just means you need to stay tuned and keep watching.
Yeah, absolutely, man. Well, this was a great first Market Monday. We had one technical difficulty. We're going to get that figured out. I appreciate you, Michael and Jay, for taking the time out to join us today and just give us some information about beginning on being interested in investing. So I was going to open the floor for a last couple of minute questions. If anybody I actually had a question. We have about 2 minutes and 45 seconds. So if I had $150, what should I be looking at or interested in to invest just to get my feet wet into the market?
Fast answer: $20 Microsoft, $20 Amazon, $20 Tesla, $10 Nvidia, $5 or $10 McDonald's and Apple, and just like throw in another company that you like. So I'd say just get a solid 5 or 10 companies that you like. Or if you don't want to do anything at all, no work at all, buy like the Dividend Aristocrats ETF that EJ was talking about, or you can buy ticker SPY, the S&P 500 index. A cheaper version of that is ticker VOO, and you don't have to do anything at all. Like it would just your money will just grow with the market if you don't want to be that risky. But that's
This
I
seemed
second-
pretty easy.
Yeah, I second everything he just said.
Cool. All right. Well, I appreciate you guys for coming in. I appreciate everybody for tuning in on the call. We'll be doing this every Monday. Well, scheduled Mondays.
Yeah, we got
Go
one
ahead,
more
Michael.
slide. Yeah, we got one more slide.
Oh, okay.
It should be one more in there. If not, then it was just the last slide was just going to show what we may be touching on next week.
Okay. There we go. All right.
So maybe this might be too advanced, but we're just going to jump straight in. The basics of technical analysis, and which that'll primarily be Jay leading that, and just touch on a little bit why companies will go public in the first place.
Okay. Awesome. All right, guys. I hope you stay safe and your family stay safe and have a good evening.
All right, everybody.
Bye.
Thanks for coming, everybody. Tune in next week.
Okay.
It's fun.